Hello, welcome to this edition of Fed Watch. It's November 15th, 2024, and I'm back. I hope you enjoyed Taylor St. Germain the last couple of weeks. He is the future. So it's a good look into ITR's future. He's one of our premier speakers. He's a very good economist, and he's just an all-around great guy. All right, so let's take a look at what's going on. The first thing that's been on my mind is the Fed did cut rates in November, right after the election. I was surprised by that. If you've been following this, I was talking before vacation. But it was a pleasant surprise. I'm glad that they went ahead and cut the rates for everybody who's, pulling for rate cuts. It's not really going to matter to the economy, just 125 additional cuts, basis points cut. Um, it's a cumulative effect, and it's the anticipation that can make people wait. Fred's been pretty clear that with the spate of news that came out recently, they don't see a need to cut rates again on December 18th. In fact, the streets got that at about a 55% probability that they will, 45% probability that they won't. So it's a flip of the coin as far as they are concerned. Reading through Powell's comments, they were pretty hawkish. But then again, the Fed's been this master of mixed messaging because she's the Fed president down in Dallas, who's not a member of the FOMC yet. She'll join in 2026. She's leaning more toward cutting rates, but again, she doesn't get a vote in December. So we'll have to wait and see. I I don't have a dog in this fight, whether they do or don't, but when you look at the CPI, how the core rate of inflation was unchanged, that came out this week at 3.3%, and how the total rate of inflation moved up from 2.4% to 2.6%. That alone would, in my opinion, make the Fed think twice about sort of a mixed signal do we want to send out there to the economy and to the world at a time when our own inflation indicators, at least at the consumer level, went up. But they also went up at PPI also. The 112 for the producer price index went to plus 0.7 the latest month. Prior month was minus 0.7. So we're seeing some resistance there. It's a great low number at 0.7, but it does seem like the easing trend has ceased for now. I did a couple of gigs this week, and so I had occasion to look at aluminum. I had occasion to look at copper, gold, silver, and we're seeing some significant upward pressure on 3 out of those 4 metals anyways. Not always for normal day-to-day economic reasons, but there is something interesting going on out there, to be sure. Retail sales look great in October. But it was October. We had, the hurricanes come through, and people buy a lot of stuff before a hurricane actually hits. So we'll have to see if that number holds up. The unemployment claims fell, and again, they were increased during the hurricanes in November. The weekly data shows that they're coming back down to normal. We might see retail sales do the very same thing. So that alone shouldn't stop interest rates from coming down any lower. Manufacturing continues to be weak with the rate of change of minus 0.2% across the board in terms of the 112, 312, 1212. U.S. industrial production was weak. The data trend, 12-month moving average data trend, fell back into recession. It's a very mild recession. It's only down 0.2% from 1 year ago. And all of that seems to be in the manufacturing sector. But it's the lowest level we've seen in 22 months now. So we're in this sluggish environment. Because I don't want to depress anybody. There is some good news hidden in that the non-defense capital goods new orders data for October came in with a pretty good number. The 112 was plus 0.7%. No coincidence. I mean, no mistake. That's just coincidence. And we may have a June 2024 low in terms of the new orders. So we'll have to see how that goes. Overall, though, with the PMI dropping down to its lowest level in 15 months, we're pretty much completing the picture of it's really a mixed bag out there. The economy is like in the economic doldrums. We're just not getting a fair wind or an adverse wind at this time. We just sort of seem to be adrift. Our own ITR leading indicator is rising. It's the highest level we've seen in 25 months, but it's still a negative number. So that also is just a mixed signal. Just a word on the election that obviously happened earlier this month. During my talks, got a lot of questions about that election. Does it change our view of what's going to happen in the 2030s? And the answer is no. Um, we haven't changed any forecast from before the election and after the election, and we don't expect that we are going to need to. As we look over the policies being put forth, we look over the timeline, we need to see a lot more detail. We need to see what the Senate is going to go along with in terms of confirmations. But at this time, we don't really see any need to change the macroeconomic forecast. I doubt that we will. We're still going to enjoy good years going forward. We still think interest rates will reach a low, likely around mid 2025, although the marketplace, and this is driving the Federal Reserve crazy, I assume the Fed's pushing on this string to lower interest rates via the Fed funds rate, discount rate, and the marketplace isn't cooperating very much. And that may be why ultimately in January, we'll see some more cuts from the Fed trying to cajole the marketplace to go in the direction that they want it to go in. So look for some good rise. Inflation is coming back, and we haven't changed our mind on the 2030s. A lot of people have been coming up to us asking, well, should we hold on to our business? Should we sell our business? When would be the best time to sell our business? How will our markets fare on the way up and on the way down? In response to that, we've developed the Financial Resilience Program. It's a blueprint, financial blueprint for your company through the 2030s. You can go online, find out more about that. When I talk to you through FedWatch, we're talking about the very short term. You got to keep this short term within the long term context, which is why we're trying to answer these people's questions. Thank you very much for watching this edition of FedWatch. It's going to be interesting, folks. Expect more tariffs, expect more inflation, expect higher pricing, and expect higher interest rates once this economy starts moving in an upward direction again. I'll see you next week.